Hello, traders, and welcome to a new episode of Beyond the Charts. Unfortunately, the government shutdown in the US still persists. Um, we're still in a data blackout. We still don't know the latest NFP numbers. We don't know the unemployment numbers. So let's talk about the ones that actually landed. But overall, this is not healthy. It's taking too long before the government opens up again. So that couldn't be healthy for anyone, especially the U.S. Government and the U.S. Federal Reserve. So let's get to it and start seeing or start discussing what happened the past week. First of all, we had Monday, we had nothing, we had some like holidays here and there. In this calendar, we see a holiday in Japan, which was the National Sports Day. No big, not a big event, no high impact on the markets, um, other than like low volumes in Japanese markets. Then we had Tuesday, which is October 14th. We had the German CPI. The previous reading was at 0.1%, the forecast was at 0.2%, and the actual number came in as expected at 0.2%, which means um, this means basically that the inflation in Germany is growing. It also means that it's very good that the ECB did not cut rates in their last meeting because they saw this coming, and we're going to discuss now the Eurozone CPI as well and the inflation in the Eurozone, which is also ticking up. Um, so basically, that's pretty much it about the what's it called, the German CPI. Now, just a small reminder. Usually, when like inflation is high, um, the rates tend to remain higher for longer to fight this inflation and go back to the uh, what's it called, the target of the central bank, which is like globally or universally agreed on at 2%. All right. So let's see, what else did we have on that day? Um, so how did it impact the market? We saw like DAX going up 0.2%. There was a mild US spillover, like 0.1% gain in S&P. But like the gold stayed flat. FX majors, mainly Euro USD, gained 0.1%, but nothing major again, okay? Because again, guys, it came in as expected. So that's the main reason. Then we had Jerome Powell speech on that same day, on Tuesday, October 14th. So what happened is the following. Powell highlighted a firmer footing for the economy, but flagged job market risks and upside inflation risks from tariffs, especially that they don't have the latest jobs market numbers. We're talking mainly like the NFP and the unemployment rates. Um, and they're going to decide on a meeting by meeting basis for the cut rates. They're not going to cut rates or just promise the markets to cut rates out of nowhere. They're going to be data dependent. So that's pretty much their approach. Like that's what Jerome Powell stated. Um, like, and as well, they're nearing, he mentioned something about nearing the end of balance sheet runoff with no preset path, emphasized data. So like data dependence remains the main narrative for the Fed, okay? So what does that mean for the markets? It means like basically what I'm looking at is a balanced dovish tone. Easing will continue if jobs soften, but tariffs are a wild card, meaning that they're going to affect how like the inflation numbers are going to be, because as you know, and as we discussed many times before, when tariffs start like taking, let's say, taking place, and they're like officially imposed, we're going to see that reflect on inflation. First, we see the reflection on the PPI or the producer side, and then it's going to spill over to the consumer side, and we're going to start seeing higher inflation numbers, which is a headache for the Fed, which has been trying very hard to progress in the inflation file. So what did that happen? What happened after that speech? Gold went up 0.5% on lower rate hints, and the USD eased 0.3%. Euro gained 0.3%. But the GBP USD gained 0.2% as well, and the USD JPY lost 0.4%. Okay, so let's move now to Wednesday. We didn't have anything, as far as I remember. Yes, we didn't have anything on Wednesday, so we move directly to Thursday, October 16th. We had the GDP from the US. The previous reading was at minus 0.1%, which was a contraction. The forecast was positive 0.1%, and the actual number came in as expected at 0.1%. So what does that mean? As you know, as we can see, it matched the forecast, rebounding from the prior dip in August. I think services drove this growth mainly, but manufacturing lagged. And that's, I think that's pretty much it. The market impact, FTSE 100 gained 0.3%. The US indices got a spillover of 0.2%. The gold was neutral. The GBP USD gained 0.2%. And then we had the US Philadelphia manufacturing. Oh, wait, guys, I see a mistake here. This shouldn't be USD, it should be GBP. This was the number coming from UK, not from the US. So just make sure that whatever we said is about the UK, not about the US, okay? I just noticed, I'm sorry. Anyway, so let's move to the next one. I told you just the market impact. As I told you, the FTSE gained 0.3%. The FX majors gained, the GBP USD mainly gained 0.2% because of that. And let's move now to the next one, which was the US Philadelphia Fed Manufacturing Index. The previous reading was at 23.2. The forecast was a drop to 8.6, and the actual came in at minus 12.8 points. And this is also a mistake. It shouldn't be percent, it's points. So what does that mean? It's a massive miss. Deepest contraction in months, mainly because of tariffs. The shutdown effects are weighing their way on regional factories, signaling uneven pain. So that's a massive miss. What did that do to the markets? The USD lost 0.2%, the Euro USD gained 0.2%, the GBP USD gained 0.1%, and the USD JPY lost 0.3%, while the gold as well gained 0.3% as a safe haven. Because, as you know, when the data is weak and there's a lot of uncertainty, and especially with the government shutdown, there's a lot of uncertainty and blackout, so people ran to the gold. Stocks and indices, nothing major as I see here. The S&P lost 0.4%. The Dow lost 0.5% on slowdown fears. So that's pretty much it. And we had the crude oil inventories. The previous reading was at 3.715 or 8, as I remember. The forecast was 0.3, and the actual came in a positive 3.524, which means that there is a lot of supply, but not there is no corresponding demand to that supply. So that's bearish for the oil prices. Okay. It was a surprise build. It was bigger than expected, bigger than the forecast, and almost bigger than the previous, or like similar to previous, um, which points to demand weakness because a global slowdown would mean less demand on oil. And it's bearish for oil despite the geopolitics that are going on right now. The stocks and indices, like, let's talk about market impact. Stocks and indices, energy lost 0.6%, Nasdaq lost 0.3%, gold went up 0.2% as lower oil tempers inflation. FX majors, mainly talking about the USD, lost 0.1%. The GBP USD was flat. USD JPY lost 0.2%, and that's pretty much it. And then we had Friday, which we were hoping to see NFP and unemployment, but again, the government is still shut down in the US, so they pulled out the NFP numbers and unemployment from Friday's calendar. So from the economic calendar, I mean. So we were supposed to have them on Friday, but again, the same thing happened, and they pulled out the numbers from the economic calendar. So the only number that actually landed was coming from Europe, from the Eurozone. The previous reading, it was the CPI year on year. The previous reading was at 2%, which was on target. The forecast was 2.2%, and the actual came in line with expectations at 2.2% as well. So what does that mean? It was like up slightly from the central bank's target, driven by energy rebound, but core was steady at 2.7, and the ECB may pause cuts because, as we saw in the beginning of this episode, I told you about the German CPI, which was ticking up as well. So holding rates like higher for longer could help like bring back inflation to 2%, which is the target. All right. The Euro stocks lost like 0.3%, and we had a softer US Open, with the S&P losing 0.2%. Gold lost 0.2% as stickier euro rates hurt gold. Euro USD lost 0.3%, GBP USD lost 0.1%, and USD JPY gained 0.4%. So the big picture, that's pretty much it for the economic calendar, but the big picture was that shutdowns, data drought, we saw like the CPI delayed and the NFP like pulled out of the calendar, unemployment as well. All of this fueled volatility, but Powell's dovish nudge and steady global CPI coming from Euro and other countries kept Fed cut hopes alive. Now the markets are pricing in a 97% chance of a rate cut on October 29th. Which is only 12 days from today. As always, guys, like trade responsibly, use stops, and be careful of the volatility during those times, because markets are not certain about anything. They don't have, they're like just driving without seeing what's in front of them. So that would cause a lot of volatility. Be careful of that. Use stops always, manage risk, and as always, trade responsibly. If you need any help or you have any questions, make sure to drop them in the comment section below. Share this video with your friends, and see you on Monday, or see you on the next one, or the next episode of Beyond the Charts. I hope this was helpful. It wasn't boring, but as you saw, we don't have enough data to discuss. So hopefully by next week we will have like the government reopens in the US, and we will have more data to discuss, and it'll be like a more certain market than we have today. So take care of yourselves, and I'll see you on the next one. Bye bye.